Wall Street is doing it again. They are abandoning housing markets that they invaded during the pandemic. And in this video, I'm going to show you how much home prices are now dropping in these neighborhoods that Wall Street is leaving. And I am coming to you right now from the south side of Atlanta in College Park. This is one of the top 5 areas where Wall Street landlords bought up homes during the pandemic, and they caused the prices in neighborhoods like this to skyrocket. Values went up as much as 115% over 5 years, but now values are correcting because there's this massive sell-off, and this is a troubling sign. This is a troubling trend for the housing market, everyone, because while it's good that Wall Street is selling and that's going to create more affordability, it's a signal that's eerily reminiscent of what we saw in 2007, 2008, right at the beginning of that last crash. Because you can see some of the homes here in College Park, when you look at on Zillow, these homes went down 60, 70% in the last downturn. Some of these houses sold for $30,000 or $40,000 the last time Wall Street decided to leave this neighborhood. And now data on Reventure app is showing that values are down 7% year over year already, and that the supply of homes for sale is through the roof. Now, this might be a little confusing to some of you because the conventional narrative is that Wall Street is buying up houses and making home prices more expensive. But that was really the narrative of 3 or 4 years ago, and now that narrative is shifting into reverse, with data from Redfin showing that investor purchases in the Atlanta metro have dropped over 60% from peak. Look at that decline in real estate investor purchases in Atlanta. And the thing about it, everyone, is that a lot of those purchases were concentrated in neighborhoods like this. So when investor purchases drop 60% in the Atlanta metro, what it's really saying is that these zip codes on the south side of Atlanta, they had investor purchases drop by even more, and it had an even bigger impact on the market. And some of you who've watched my channel over the last year, this might not be huge news to you because, you've seen me in Florida showing you the investor sell-off in Florida and how home prices are going down in Florida. But what I think is fascinating is the fact that this investor sell-off is spreading now. It's spreading to metros like Atlanta. And I have a feeling as I go along this road trip over the next couple weeks to other markets in the Southeast, I'm going to find even more of these real estate investors selling. And let me just explain to you all the relevance of this, right? The relevance is that these investors, they are getting out of the market for a reason, right? They're seeing something in real time on the ground. And if you watch, other real estate investors on YouTube, they talk a lot about this. The fact that the rental rates are no longer growing the same way they used to. In fact, the rents here in Atlanta are going down. The fact that property taxes are surging, insurance rates are surging, and this combination is making it no longer profitable to be a real estate investor in a lot of markets, especially with interest rates and mortgage rates close to 7%. And I actually just found a listing a couple blocks over, everyone, that I want to show you all. This is a house for rent, and it's owned by an investor out of Seattle. A Seattle entity bought a house in Atlanta in 2022 for $320 grand. Then they put it on the market for rent. Now, they originally had it listed for rent around $2,300 a month. Then they cut it all the way down to $1,710 a month. It's on the market now for $1,710 a month. It's a leasing special. We'll see if they get that rent. But what's amazing about that rental cut, everyone, is that when you do the math on how much money that investor's making, it's barely anything. Because say they get that $1,700 in rent, let's do some math. Well, that's $20,000 a year in annual gross revenue. Then you got to subtract your 10% vacancy loss. Then you got to subtract your $4,500 property tax bill. Then you got to subtract maybe your $2,500 insurance bill. Then you got to subtract your 5% management fee, as well as some miscellaneous costs for maintenance and utilities. And pretty quickly, wow, that investor is going to be making less than $10,000 a year unlevered on that property when they paid $320,000 for it. That's a 3% cap rate. That is not good, everyone. A 3% cap rate. What that means is that they're only getting 3% a year return on the rental property they bought, and that's not even factoring in their debt and interest costs. When you factor in their debt and interest costs, which I assume there are, they could be losing money on that house. And this is just a great example of the reality for real estate investors in America right now. This market has shifted so much with where interest rates have gone and where property taxes and insurance have gone. And that's why a lot of the big ones have started selling and selling at losses. And the unfortunate thing about it is that these investors really destabilized a lot of these local housing markets, right? So south of Atlanta, this is a more lower income area, lower to middle income. We're near the Hartsfield-Jackson Airport. You know, a lot of blue collar working class jobs here. People who, save up money to buy a house. These houses used to be a lot cheaper. And some people might have liked that the prices went up here after the investors bought. But now this market is of high likelihood of crashing. It's already down 7% year over year, according to data on Reventure app. Our 12-month forecast for College Park is minus 8.7%. So if that forecast comes to fruition, it's going to be a 16-17% correction. And when you look at the number of homes on the market in this zip code, data on Reventure app shows that there's almost 400 homes on the market as of June 2025. At the pandemic peak, there was only 63 homes on the market. And prior to the pandemic, there was around 200 homes on the market. So inventory here is up 80% from normal due to these investors no longer buying and starting to sell. And I'm like scratching my head about this, everyone, right? Because I tend to celebrate when home prices go down because it's good for buyers. I tend to celebrate that, and I think a lot of you guys watching this video think it's a good thing. But when I see such an egregious case of investors invading an area in a short period of time, bidding the prices up and then leaving, and then causing the prices to correct hard, I start to think that's not so good. I start to think that increases the risk factors for anyone who would buy in a neighborhood like this, especially with a mortgage. I mean, imagine you were to buy with a 5% down FHA mortgage in this neighborhood. Say you bought two years ago with a 5% down FHA mortgage. You are now underwater on your mortgage in terms of value because these investors decided to leave the market. And this is the thing about the housing market during the pandemic that I don't think people properly understood. You know, all the news articles were talking about how investors were going to cause home prices to go up forever. If you remember those articles, everyone, you can let me know in the comment section if you do. You know, investors are taking over, Wall Street's taking over, it's going to become a country of renters and landlords are going to dominate. Well, that happened for a couple of years, but really what these investors do is they destabilize the market. They cause more volatility. So they don't cause prices to go up forever, they cause the prices to go up for a while, and then they cause the prices to crash. And that's the situation we're seeing play out here in Clayton County, Georgia, in the middle of 2025. Now, another big Wall Street investor that was buying up homes in this area during the pandemic and still owns some homes in this area is Opendoor. Now, you guys might have remembered Opendoor from when I started talking about them 3 or 4 years ago. I actually called in late 2021 the peak of Opendoor stock on my channel back when it was trading for around $40 per share.
Now, as I said earlier, I opened up a big bet against Opendoor about a month ago. I said to myself back in early November, what's going on with Zillow is a big sign of what's going to happen to these other companies. Opendoor is overvalued. I'm going to open up a put option and bet that Opendoor stock price is going to decline. Well, now in early December, that bet is looking very, very good. And I'm going to show you at the end of this video in a little bit just how much money I've made off this bet.
And I knew Opendoor's business model of buying and flipping homes was not very sustainable in this market and that they were going to run into issues. Now, Opendoor's stock has plummeted since then. It got as low as 70 cents a share until a couple weeks ago when the Reddit army, the Reddit Wall Street bet army, started identifying Opendoor as a candidate for a short squeeze. Because a lot of hedge funds and big investors were shorting Opendoor's stock, betting that it was basically going to go bankrupt, even cheaper than 70 cents a share. So a lot of retail buyers and investors on Wall Street bets, they said, hey, let's buy up Opendoor shares and cause the shorts to have to cover their calls. And in the end, this has caused Opendoor's price to spike. They went up about 400% over a week. Opendoor is now trading around $3 a share. So it's still pretty low compared to what it used to be. But Opendoor is now the new meme stock. You know, if you guys remember GameStop 4 or 5 years ago when GameStop shares were really low and then surged due to retail frenzy of buying, that's now happening with Opendoor. And of course, Opendoor's business model, in my humble opinion, this is just my opinion, Opendoor's business models, not very good. They essentially buy a house in cash and then turn around and sell that house a couple months later, and they earn a fee in terms of buying it, and then they try to make a profit on selling it a couple months later. But what's happening in markets like Atlanta right now is Opendoor is starting to get caught. You know, they buy a house 2 months ago, 3 months ago, and then the value's lower 3 months later. So Opendoor, they're starting to struggle because of this, and their transaction volume and revenues actually declined precipitously over the last 3 years, according to their SEC filings. But now, folks, here's the good thing actually about where I'm standing right now in College Park, south of Atlanta, Clayton County, Georgia. We're near the airport. We're near Tyler Perry Studios, which is the big movie studio about 5 miles away. I'll say the real one positive about this market is it is affordable. So prices are down 7% year over year. They're still way above where they were before the pandemic, but you could still buy some houses in College Park, and you could buy them for 250 grand, 230 grand. For instance, you can see here, this house is on the market for $220,000 currently for sale. 220 grand. It's a smaller house. It's around 1,100, 1,200 square feet, but 220 grand. Your monthly payment on this, if you were to buy it all in, less than 1,500 a month. And you know, to address the elephant in the room here, College Park in south of Atlanta definitely has a reputation. And that reputation is that it's not such a good area. You know, the reputation is that it's higher crime. The reputation for Clayton County is that it's higher crime. And you know, it's something where I think the crime rates have actually improved a bit in this area. I think it really depends on where you go. Certain areas are better than others. So it's certainly something to think about. But actually, one thing I like about it, folks, is how green it is. Like if you look at just this view, it actually is very picturesque, very idyllic. A lot of trees, a lot of green, a lot of grass. You know, certain neighborhoods and certain areas here do actually feel and look pretty nice. So I wonder if some parts of Clayton County are improving just from a fundamental standpoint, and maybe this area will continue to get better in the long term. However, in the short term, these investors are just really destabilizing the market. I found another listing here in College Park where the seller was losing some money, folks. Take a look at this. The seller bought the house for $327,000 in 2023. They then tried to sell it in 2024 for $344,000, and they've since cut the price to 300 grand. It is now contingent. So we'll see if it sells. But what I think is interesting is the seller on this house in College Park, they are losing about 10% on the purchase price. But on top of that, folks, remember, if you buy and sell a house, you always have those realtor fees and closing costs as well. So when you buy, you got 3% to the buyer's agent, and theoretically the buyer only covers the 3%, but I think we all know the prices are inflated, so the buyer covers the full 6%. And then you got, you know, title and legal and all that type of stuff. So when you buy a house, you got an extra 7% you're paying at closing. So if you're losing 10% on purchase price, that's really a 17% loss all in when you factor in your closing costs. And if the seller on that house had actually been using Reventure app, they would have known when they listed over a year ago, they would have known that the values were going to drop. Our home price forecast score dropped to a 39 out of 100 in the zip code a year ago, and essentially predicted the decline in prices that would have taken place. That investor would have known not to list at 344 last year, to list maybe at something like 320, 325. They probably would have sold their house if they had done that. Instead, they listed high, sitting on the market, have to cut the price by more. We're just seeing a lot of sellers do that around the housing market right now. Now, one big thing that could shake up the housing market later this year, everyone, is capital gains tax. Because right now, and this could be particularly important for investors, everyone, right now, the Trump administration, as well as Marjorie Taylor Greene, are floating a policy to eliminate capital gains tax on home sales. This has just come out over the last week. There's a bill in Congress right now that's been introduced that would eliminate capital gains tax on home sales. And the whole idea about this proposed policy is to free up more listings on the market, allow more people to sell their homes, because theoretically, if you eliminate the capital gains tax, that would cause more people to be inclined to sell because they wouldn't have to pay 15 to 20% to the government on their appreciation. And that's the basic idea. An important caveat is that the proposal would only be for primary homeowners. Only primary homeowners would be able to claim no capital gains tax. However, I want to suggest something to the Trump administration, actually. And that's that I think you want this to apply to investors, because there's a lot of investors who bought their homes 10, 20, 30, 40 years ago, who have made a killing and aren't selling because of the capital gains tax. So what I would propose, if you're going to do this, is include investor properties, but limit it to people who have owned their investment properties for 15 years, let's say. Because we don't want to encourage short-term speculation with no capital gains tax. We want to encourage investors who have owned for a long time to sell. So right now, I think there's around 24 million investor-owned homes in America. So almost 1 out of 4 houses is owned by an investor. And in certain markets like Atlanta, some of these investors bought some of these houses for 50, 60 grand at the bottom of the last crash and are trying to sell them for 350, 300 grand. And so would you get more investors to sell if you told those investors, hey, no capital gains tax? I think you might. But again, the important thing is you don't want to have a policy that encourages more investors to buy, because that would not be good for housing listings. That would not be good for the average home buyer. We want investors out of the market. We want to hasten their exit from the market. So I think the Trump administration should look into that, how you could tweak this policy to try to incentivize long-term investors to sell without incentivizing short-term investors to buy. And according to CNBC, there's around 37 million primary homeowners who would theoretically be covered by this proposed elimination of capital gains tax. So we might get some of them to sell too. In the end, around 50% of you said this was a good idea, 25% of you said it wasn't, 25% of you said you're not sure. Now folks, I've been in Atlanta for the last week and I am about to leave Atlanta, and I want to hear your suggestions about where I should go next on my road trip. I'm continuing my road trip across the US housing market. I'll be on this road trip for the next couple weeks, coming to you live from different housing markets. And just so you guys know, in this video, I was in zip code 30349. 30349. Get out your ReVenture mobile apps, type in that zip code. You could see that values are down 7% over the last year. You could see that inventory is up to 400 homes. And what I would encourage you guys to do is download the ReVenture mobile app so you can follow along in future videos, and make sure to actually upgrade to that premium subscription so you could see our 12-month price forecast. For this zip code, we're forecasting prices are going to go down 9% over the next year. But in Buckhead, where I was a couple days ago, we're forecasting prices are going to go up 1%. So you're going to want to know what that 12-month forecast is for your area. Super easy to access if you just download that mobile app right now, click the upgrade button. Let me know what that forecast is in your market.